So let's get started. Okay. Can you hear and see me, guys? Good. Okay.
Yes.
Then I also will try to reduce that one here. Okay. Now. Okay, doke. So welcome to the last session of our Venture Building Like a Pro series trilogy. Today, we're going to focus on management and growth. Those are the three areas, so product management and growth. My name is Peach. I am the co-founder and CEO of Axelra, and today I have two very interesting guests with me. On my left-hand side is Stefan. He will introduce himself afterwards, and as well we have Daniel Faloppa, the CEO of Equidam and founder, and we will talk about that in a minute. So what's the topic of today? So it's about venture building from funding. It's about customer acquisition cost, customer lifetime value in Swiss B2B, B2C fintechs, and data-driven valuations with Equidam. And what we prepared is, first of all, the summary of all the trilogies. So for all of them who made it also to the last two sessions, congratulations. So you almost earned a small MBA, no joke aside. And today what we're going to do, I give a short introduction to the kind of a summary of the last two sessions about the tech venture building journey and its 4 stages. It's something like the 4x4 important things to memorize when building such tech ventures. Then about the tech venture building plan. So it's a tool set that we defined when we start to build and launch such ventures. And I'm going to hand over to Stefan, who talks about the perfect pitch to understand and also to formulate towards potential investors, and also startup metrics on what to focus. And this everything related to pitch and raising funds had always some correlations to the topic venture valuations. And here Daniel Faloppa kicks in with all his knowledge, experience, and Equidam set that he brings along. We will then deep shortly into the tech venture funding map. Also have a little surprise here in that chapter and open up for interactive Q&A. So thanks for spending your lunchtime with us. And I directly jump into the first slides about Axelra, what we're doing. So we are a tech venture builder. So we do build and co-create and ship revenue generating MVPs after 100 days. We are 5 years old now, a little bit more. And we do that for corporate and startups with skin in the game to ensure we have aligned interests. We so far built more than 40 or accelerated more than 40 companies, co-created more than 20 tech ventures. And in the process of doing so, we had also the opportunity to get a stake in those organizations, startups, so 10 out of 10. And we are working on those 3 different areas. And if you ask yourself, what's a tech venture builder, you might are familiar with the terms company builder and startup studio. More or less, they are the same. And there is a big rise of venture builders around the world. Also in Switzerland, there are not so many actually. And when it comes to tech venture building, so if they have a tech or digital business model, or the business model focusing on digitalization, there are just a few, but it's actually the process of creating startups together with somebody else. And why do people go to those venture builders? Actually, they hope to get better economics and a better chance of success. And in the end, that's also somehow statistically proven that the IRR and the multiple you can raise and the time to markets you need also in order to go from 0 to Series A is much faster. And the last time, and then the ad block is over, we also had the pleasure to be awarded this year from Financial Times to #1 startup hub in Switzerland and Austria. There was a big study about that, and we are very happy to that. So now let's go into the stages of tech venture building. So you might have already survived that interesting curve here, but it starts with a decent level of happiness and your super enthusiasm about getting started, and then the reality really kicks in, and then is a really a valley of pain, blood, sweat, and tears, which is not always that funny, but sometimes you kind of reach product market fit and scale. But it's a tough journey actually, and it has a lot ups and downs in it, and it's just a very specific group of people who want to spend their lifetime in such a curve. I'm one of those who do enjoy a lot of parts of that curve, not all of it, of course, but the resilience training helps a little bit. But in the end, in Switzerland, a lot of startups gets incorporated every year. In 2023, it's about 51,000 different startups, and also a lot of money flew into that. Actually, we know that we knew or received a message and also really feel it impacted by that the amount of money decreased that is flowing into those ventures. So therefore also raising funds is a challenge. But what's interesting to see is they had, or in Switzerland, we had around 10 years, very beautiful increases in the invested capital. So it seems that the private equity class of startups is pretty interesting one, but it's also a tough one to understand. And what we learned in 2023 Q4 is that the amount of rounds didn't decrease, but the money increased, and especially for early stage startups, it didn't become much easier to raise funds at the beginning, and the risk is very high at the beginning of starting such a venture. And if you take a look to why do startups fail, and actually statistically 80 to 90% of the startups will fail, 10% in the first year and 70% in the second to the fifth year. Most of the time it's of really not having a need they address, or the timing, and the timing is still very, very different, difficult to fit. You just need to try it. And then it's team, it's idea, it's business, but it's the last point, then funding. So if you really find something that the market needs, it's really possible to do something. But also Switzerland is not such a large market, and there are not so many problems to solve where you don't have some other opportunity to get it solved somehow. And what we try to do as a venture builder, we try to accelerate the process from there is nothing to you create the product, you verify it, you validate it, you roll it out, you start to generate the first couple of revenues, and then we hand it over to the organization. And this acceleration for the 100 steps, this one we want to decompile a little bit, because it's a complex topic. It's also sometimes a little bit different from startups to startups. There are similarities, but it should not be, okay, that's a miracle and we did to figure out. And after having performed that with the team more than 40 times, we have some methods how to do that. And that's the 4x4 of tech venture building like a pro, which we would like to share. So actually, every startup founder, founding team, startup need to go through those 4 fits to master the challenge. First of all, is really starting with the problem, not with the solution. It's really starting with the problem and the customer need to find, okay, look, we now have identified a problem, and that's a real problem, and it's worth solving it. That's a hard one to find. The second one then is design and validate with customer that your solution that you just created in a very short time at least partially solves the problem. And then after you solve the desirability and the feasibility, you try to have the viability solved. When you prove that you're able to launch an MVP and sell your solution or whatever it is, it can be product service to the market. Don't need to be profitable at this point of time, and don't worry about the scaling things. That one kicks in later on when you work on the business model fit. And it's important to focus in the right stages on the right thing. So it doesn't make sense to spend a lot of time in step one where you worry about the customer problem fit, about can you scale it and how you scale it. That's important, but it's important later. So that's the first one I want to bring. The second one, the stages we start to structure in a proper way. We also have aligned our offering where we help and accelerate to those offerings. So we have the ideation, validation, launch, and scale. And we also describe what things you need to focus on and how we evaluate it roughly and who is going to support you in investing. And what you also see is the information that building a tech venture will consume. And I mean, tech venture is not building an e-commerce shop and sell something online, but really have a tech team sitting here, create and shape some technical IP that this is going to consume around 3/4 to 5 million cost, which you probably do not have, but you need to convince somebody else to give away some stake of the company that he's gonna kindly co-finance the journey until you get profitable. And we try to bring it very early to the point where you can prove with a couple of francs that somebody is buying something that you produce. The third thing are the 4 areas which we believe we should be working on. It's on one hand side, of course, the product area where we design product and service offerings with a tech team, with UX, with whatever it's needed. And the other one is then as well the management area where we build the company with funding, business model, trust services, plan, recruiting, and so on and so forth. And then accelerating growth, so sales at the beginning, see that there's really traction. And in the end, the overlap of everything is managing that delivery, the execution, which is important. And then the last thing that helps us in doing that are boosters. We kind of created something like Lego bricks in the areas of onboarding, identity management, traffic generation, conversion, customer lifetime value enhancement, and operational excellence and customer service, where we can kind of reuse and compose in a way that we do not invent the wheel completely from new, that we have kind of benchmarks that we can use for other things. So that allows us to become a little bit faster. And now the venture building plan, you have a lot of stages. You need to somehow plan it. At the beginning, you have just an barely overview of where you want to go. We created something like a plan or a deliverable we are creating at the beginning. It's called the venture building and business plan. And this concludes an overall plan, including the handover across all the parties for what needs to be done. So in a simple t-shirt sizing, by the way, is a term that you just try to say, okay, this is a 1 day, 5 day, 20 days, whatever effort in order to create it. The capacity handover and recruiting. So if we are delivering something and we help our founder teams to build out the team, who we need to recruit and to whom we need to hand over. And then a rough business plan of, okay, look, this is later on when we have the MVP around the revenue structure and the cost structure. And we do find theoretically a way with some assumptions we can justify that we start to earn money. And in the end, that also triggers then the funding approach. And this everything shizzle dizzle here, you can see we just combined in one single master Excel file coming from consultancy. I'm very sorry for that, but I cannot change it. I'm always having Excel files. So on one hand side, we have the estimation t-shirt sizing where we break down and say, okay, look, this is what we do. This is what you do. This is whom do you going to hand over. The second one is the capacity planning. Okay, with that team, we're going to build up over time and this profiles we need to recruit. And at this point of time, we work in parallel and then we hand over. So this theoretical plan becomes a really staffing plan. And then the third one is then a business plan, which we try also to conclude the information and then say, look, then we hit profitability and then we have break even and then the case is positive. And in the end, of course, the funding approach. So, okay, this is the money we need. This is the structure of our revenue and cost side. And this is to what extent we need to raise funds and how we evaluate it. And especially for the valuation part here, we do have a partnership with Equidam, which we found that interesting that we wanted to have Daniel also here. So that's a little bit about all the stuff. So imagine you now have aligned with everything. The internal planning view is done. And now how you convince your idea and you spend months of your lifetime within, how you convince external stakeholders in 10 minutes about what you want and why should they be convinced of giving you the 3/4 to 5 million. So this is the point where I hand over to Stefan.
Yeah, and just to make it more concrete, with external stakeholders, we actually mean investors. It's not so much about your clients in this webinar. Just to quickly introduce myself, my name is Stefan Büttler. I work for Axelra as a senior venture builder, and my primary domains from the 3 pillars that we saw before from Peach's slide is management and growth. Well, Peach taught you about the importance of this well thought through venture building plan. We love tech ventures because they have, some of them have very scalable business models. The crux with tech ventures is that most of the time you need product design and development that is kind of expensive, and you need to have upfront investments before you get revenue, compared to a consultancy that you just need a laptop and you can get going and can do revenues, right? So, but what investment sources are available to you? I mean, this is one for you, the audience. What funding sources for tech ventures startups do you know? Can you kind of write that in the chat? And let's see at some of the stuff you already know.
Let's see for the chat if there's something coming up, right?
There's a few
here. Please just write down some sources you know for funding if you have them.
Where do you get your money from to kind of build your idea? Okay, there's not a lot coming in. We'll get back to that. Self-funding, yes. Or bootstrapping is definitely one. Foundations, which is probably grants. That's a good one. Thanks, Stefan. Angel investors and VCs. Keep them coming. Crowd, yes, sure. All right, super. We'll get back to that in the last section of today's webinar, when we introduce Axelra's funding map. But I've seen it, and probably best known source of funding for tech ventures is venture capital, which includes business angels and venture capital funds. But how do you actually convince business angels and VCs about your great business idea? Yes, the pitch deck. Developing a compelling pitch deck is probably one of the hardest things to do in the early stages, and it's a tedious task for most entrepreneurs. So maybe, what is it, a pitch deck? Maybe it's easier to kind of start what it's not. So it's not your 250 pages business plan that you normally use to get funding from your bank. You can save that time, they won't fund you anyway. So it's not your sales presentation. So it's not all about your product and the features and how much value it delivers to your customers. No, the pitch deck is something else. The pitch deck is your story packaged and presented to convince investors of your vision. Let me quickly iterate it. It's your story. So it's really kind of why you're doing that. It's packaged because we'll see later, there's different components to it. And you should really have a story to tell about each and every component of a good pitch deck. And it's really kind of packaged down, condensed down to the real essentials. It's really the goal of the pitch deck is to convince your investors of your vision and then get them excited to invest in your business idea. So over the years, I've probably seen hundreds, if not thousands of pitch decks. While there are different school of thoughts, how to present it, how to structure one, I just want to share quickly with you my train of thought, and we'll start. Thank you. We start here. Just quickly, to phrase this correctly, you should keep it condensed. So it should not have too many slides. Coming to back later. And it should also have some different components. So for example, a lot of companies really start, and Peach mentioned that in his part, that it's really about the problem and the problem you're solving for whom. So who is your customers? What problem do they have? And really try to personalize that story from the beginning. So we see founders that have worked in the customer's space before, they have experienced the problem themselves and then can really relate to that story. So that's really compelling to investors if you have suffered through the problem and know it by heart for yourself. Then the next is offer a glimpse of hope, promising to resolve that problem that you just sketched out with the value proposition, or some call it solution. So what are you helping the customer with to solve that problem? And how are you going to deliver value for the customers? The next is if you already have it, kind of a compelling demo of your solution, or at least a few pictures with your solution in action. That really helps to make it concrete. I've seen some ETH startups that have really kind of very technical drawings as a demo, but the investors really can't follow. So that's not good enough. You really need think of the investors. They know a lot, but they don't know primarily your solution or the industry you're working in. So make it easy for them to follow. The next is go-to-market strategy. So really, like, how are you going to win customer? Let them know whether you're going B2C, B2B, are you working with distribution partners, and so on. The business model, explain how your company is going to make money, be clear about pricing, revenue streams, and kind of key assumptions underlying your financial models here. The next part is the market and the size. Really, what market are you in? How big is the opportunity for you and for your potential investor to invest in you? You can Google it yourself, but there's kind of these thumbs that you show and slice the market. So it's really easy for the investors to follow you along. Next is competitors and your unique selling proposition, or your uniqueness. Here, maybe a quick tip. Don't just compare yourself to your obvious competitors, but also take in indirect competitors. So, for example, if I would be building a flight booking platform, I don't just consider eBooking or eBookers or Booking.com as my competitors, but also the traditional travel agency. And how does my offer compare to them? So kind of mine is 24 hours available and theirs is not. The next thing, really important slide, is market traction. So where you really show off your metrics, what you have achieved over the last month, years, whatever, at whatever stage your company is. I get it. It's hard in the beginning. You don't have your revenue increases triple every year. So go with what you can do. Customer testimonials that really praise your product, or partnerships that you were able to close, or funding that you were able to take on. Even if it's just a grant, it helps to convince investors that you are a team that can actually execute. Roadmap, I think, is pretty obvious. Lay out the plan, how you're going to build the company out, and not just the product, but also the company. So what markets are you in? How's the product going to evolve? How much people do you need? And then, of course, the team. And don't just put your pretty pictures there, but also kind of show investors why you are the right team, have the right skills to actually execute the plan. As Peach already mentioned before, you need to have your financial projections ready, your assumptions, and so on. show them the case for them, show them a way into profitability, even if it's just down a few years till you really get there. And the last one that I see a lot of startups forget in their pitch deck is the investor ask. So what do you want from the investor? I mean, I guess you have a funding need to achieve a milestone in the future, and you need, let's say, 500K to achieve that milestone. Explain exactly what you will be using the funds for. So whether it's kind of product development, 30%, 20% sales, 20% marketing, or whatever the mix is. Don't just write there like all salaries. Huh? It's you need to show them where it's going and not into people. Well, maybe just a few more tips. As I said before, the sequence of the slide doesn't really matter too much. I know some startups that start with the team. You should not end with the problem, but you can also start with the team. You can start with the market size if it's that huge and you want to show off the opportunity. So it just needs to be in line with the story you're going to tell, and you need to, each slide needs to have a clear purpose and deliver key information without overcrowding it. And investors should be able to follow you along and have it in a comprehensive flow where investors are able to follow, and be sure that you're consistent. So as an example, if you're showing your roadmap where you want to take the company, your financial plan should actually be in line with that. That's also something that we see, that the roadmap shows I'm going to go to a new market in a foreign country, but it's not reflected in the financial projections. But these are kind of the tips that I wanted to share with you. And one more thing, you might not get funding with your first pitch, so always listen carefully about the feedback from the VCs you're pitching and reiterate and refine your pitch deck as you go along. Good. Gotta go faster a bit. We can skip that. Let's dive straight into startup metrics. As we've heard before, the startup metrics are really important, whether it's in your pitch deck, but also in your day-to-day decision making. So how do you going to steer the company, your venture to success? There's tons of metrics out there. I've just compiled a few of them that I think are really relevant, and I just want to kind of go through some of them and pick them out. You'll get the slide if you're more interested. You can still deep dive later on. But maybe to kind of pick out some, I mean, financial metrics still really relevant. Revenue, I think it's quite obvious. Burn rate is a term that you need to know if you talk to your investors. A burn rate is actually the amount of money you're spending for your operations and product development every month. So kind of how fast you're burning your cash. That also relates to the runway, which is basically how much time do you still have left with all the cash in your bank. So let's take an example. If you have 500,000 in cash on your bank account and you're burning 550K every month, you kind of have a leeway or runway of 10 months until you run out of money. And that's not what we want to see. Gross net profit and margins and so on. I think it's most of you know that from your business backgrounds. I think don't relevant. I will shorten the customer metrics because I will deep dive on customer acquisition costs and customer lifetime value later on. What we also see, customer metrics are not the number of downloads you have on your app. Huh? That's kind of vanity metric. It's not really helping you steer the business. There's also interesting ARR matrix. You can Google them yourself. It's quite a comprehensive framework for early stage startups, how to steer customer funnel. Then we have product metrics. They really provide the insights on how users interact with your product and help you optimize your product. So it's kind of an activation rate. So it's not really onboarding, but it's really kind of, for a neobank, for example, how many customers actually deposit their first 100 Swiss francs with you. User retention and adoption rate are other metrics you can use kind of to steer the product side and really identify ways of improvement. The last is growth metrics or some might call it marketing metrics. There are tons out there as well. I think important one is the customer acquisition rate, and for SaaS models and subscription business, monthly recurring revenue is definitely an interesting measurement. Well, what I wanted to say here, there's a lot of metrics out there, and what you need to make sure is you have some goals, your business goals that you want to accomplish, and the metric should actually support you in the decision making to reach those goals. So my tip is don't track everything. Probably you can't do, or you don't have the data for it, but really focus on some certain metrics and always ask the question, does this really help me make better decision to achieve my goal, my business goal? I have to stress a little bit, but just two metrics that I want to deep dive that I think are very interesting is the customer acquisition costs and the customer lifetime value. And more important than the formula itself is like, what is it? So the customer acquisition cost is the amount of money your startup or venture spends on acquiring new customers. This includes marketing and sales expenses and so on. And then it's really about measuring, building a baseline, and then start to improve your customer acquisition cost. Improving meaning lowering the customer acquisition cost. And you can do this by, checking the marketing channel effectiveness, optimizing conversion funnels, segmenting your customers, and just focusing on the most profitable or customer segments that have the lowest CACs. That's kind of the customer acquisition costs. The very related metric is customer lifetime value, which represents the total revenue a customer is expected to generate throughout their relationship with your venture, which kind of means how much money can you capture from that customer over the time they spend on your platform, on your product, or whatever you're building.
And it's super stupid if you have a case where the customer acquisition cost is higher than the customer lifetime value, or you don't even know the two of them, which happens regularly.
Yes. So you took the strong point away, Pete. Yes, you should aim for a higher CLTV than the CAC. And there's also kind of a rule of thumb. I will show you these can vary depending on the industry, your business model, and so on. But the rule of thumb is really kind of the ratio of your CAC to LTV or customer lifetime value should be in the kind of 1 to 3 and upwards thing. So meaning the LTV should be at least 3 times higher than your customer acquisition cost. And I have copied this out from a study in the US, so take it with a grain of salt. But I think it's very interesting. What I wanted to show is that the different industries, those customer acquisition costs vary heavily. Financial services with fintech and insurance are quite high. On the other side or the lower side of the spectrum, you have e-commerce, which has much lower customer acquisition costs. So for a SaaS business, you're somewhere averaging at 702, but take these averages with a grain of salt. Also in fintech, with the 1,450, you have neobanks with the account and card. Their customer acquisition costs are very low, much lower than, for example, a robo-advisory investment platform, where the customer acquisition costs are normally higher, but also the CLTV, so the lifetime value, are higher.
Maybe two insights from two venture and network here. So when we started with Freya, 3A pillar savings, the starting point for the customer acquisition cost, if you would be true and fair, would be around 1,400 Swiss francs. And if you see, for example, Neon also started with a couple of hundred francs, but over time, and now having acquired more than 140,000 customers, it's significantly below 100 francs. And you have this market brand effect, of course, that kicks in, but that takes a lot of time. So you should not decrease the customer acquisition cost too fast. And for crypto, let's say, startups who do not have complicated onboarding stuff, it can be as low as 10 or 20 francs, but also over time. And it's important to experiment a little bit around to get, but it makes sense to have a decent amount of money activated in the business case, especially for B2C cases. And that's important not to underestimate it, and also start with normal numbers.
Exactly. So now you have your pitch deck, you have your compelling traction metrics available. Next step is you go into due diligence and term sheet negotiations with your investor. And one of the probably most debated points in this discussion is the valuation of your metrics. And you really should have your numbers and arguments ready if you go into these negotiations. And we have brought with us Daniel, founder and CEO of Equidam, who is an expert in venture valuation, and therefore would hand it over to you, Daniel.
You should be able to click now.
Yeah, I'm good. Thanks. Thanks, Stefan. So much content. It's we're trying to do a lot today, a little MBA, but
yes.
Now we're gonna try to cover a bit of valuation in also 15 minutes, but at least the main principle. So as Stefan said, yeah, I'm Daniel Philip. I'm the co-founder and CEO of Equidam. For now more than 10 years, we've been working on the crux of startup valuation, trying to make sure that valuation is not the deal breaker between entrepreneurs and investors. We valued more than 140,000 companies. We work with a bunch of partners trying to educate founders, educate investors, also partly on how to set realistic valuations that are not contributing to the hypes and droughts of the startup market, but they are actually trying to smoothen them out. So that's also part of our mission, but that's why we are here to talk about this today. So I just wanted to give you for today the main principles of valuation, and just leave you with something that is actionable, at least that it can inform how you can think about these problems in the future, right? So the first important thing to think about is valuation is always about the future of the company, right? And everybody goes like, oh, but we have users, we have data, we have traction. Yes, that's extremely important to understand how that future will play out and what is believable and what is not believable about, if a company has already 1 million users, it's going to be very easy to believe they're going to do 1,000,001, right? But if the company has 0, then getting to that 1,000,001 is going to be a lot harder to believe, right? So when we look at the future of the company in the context of valuation, we're looking at two main metrics, two main pillars that are really the foundations of the framework. So the first one is the potential, so the return, how big can the company get, how much cash flow can be generated, how much revenue, and that's why there's a lot of focus of investors on market size, how big is the market for the venture, and so on and so forth. The second part is risk, right? So what's the probability of that return becoming actually true, right? Is it certain? Is it not? And of course, it's a distribution, right? It's a spread of what can happen in that future. It can be even better, or it can be a lot worse with a certain probability. So all these assumptions about the future risk and return of the company, they are normally in the pitch deck, as Stefan was saying. They are part of a story, right? So then in the end, valuation is always based on the story of the future of the company and how much is going to be believed. Having said that, if we want to increase valuation, then we work on increasing the potential, right? So having a story that says, you know, the company is gonna like do more things, get into more markets, get into more geographies, and so on and so forth. And that's what we see a lot of founders doing in their deck, in their stories, in their plans. But what is a little bit overlooked more is decreasing the risk of that story, right? And that's where really talking about all the milestones, whatever has been achieved so far. We see like a lot of decks that don't even talk about, you know, what has been done so far. Like, is the company to market already or not? Like, you know, like a lot of, I almost suggest always to put everything that has been done somewhere in the deck, so that at least people know that what has been done so far, because that really helps decreasing the risk in the mind of investors, not to an unreasonable level, just to a level that matches what you know about your own company, which is normally a lot more than what third parties know. So when we work in valuation, we try to capture these things in numbers, which is obviously a lot easier said than done. But the way that we do that starts with financial projections, right? So as was already discussed, normally startup funding starts with an ambition to solve a problem for some people. That ambition turns into a strategy, a plan, and then that plan needs to be turned into financial projections at some point, sooner rather than later, and of course with different degrees of certainty, but it needs to be done like that. And then what we always suggest is to use those financial projections to double check that the ambition is possible, right? And by iterating through this wheel, get something that is very, very solid before putting it in front of investors. So once you have that plan and those projections, we try to turn those numbers into valuation. That's really what Equidam does, but we're not the only ones. We're kind of the only ones that do it online, and we are the largest ones online, but you know, you can do it yourself on Excel. You can talk with advisors and valuators, but the idea really is to use those projections to understand the potential, and then use a lot of those assumptions of where the company is already to understand the risk, and then put the two together to calculate what's the current value of the company. In our specific case, we use 5 valuation methods, which we didn't invent. We just codified and added a lot of data in the background, and we made them easy to use for people that are not proficient in these activities. And the result is a 24 pages valuation report that people use for negotiations and to understand their valuation better as well. Again, like I can talk about this for 20 hours, but we have space for questions if for whatever comes. But the main idea here is, if possible, to use more than one method. So startup valuation is, but any valuation really is complex, and looking at the value of something from different points of view really help, right? So let's say you're valuing a painting, right? You're gonna value the name of who painted it. That could be a way. You could value like the size of it and the weight of it, like how much paint was used, right? So these are two completely different methods that are gonna yield to the value. And for companies is the same way. And for us, we use some qualitative methods that compare the company with other companies in the same stage. We use 2 qualitative methods, and then we use a VC method, which basically tries to reverse calculate. It estimates an exit for the company. So let's say the company is going to exit in 5 years at 100 million euro valuation. And as an investor for this type of risk, I want to have 50% return per year, 70% return per year, something like that. So what would be the price I'm willing to pay today for that return, right? So that's how the VC method works. And then the other 2 methods are called discounted cash flows, and they really look at the cash flow potential, cash flow generation potential of the company in order to understand how much would it be worth today. What we saw over the past 10 years with our data is that the combination of these 5 works really well, where the qualitative ones are used to value earlier stage companies, where the financial projections are, a little bit more difficult to determine, a little bit, a lot more uncertain normally. And then as the company develops and we can trust those financial projections more and more, then we put more and more weight onto the discounted cash flow methods and the VC method, where that depend on those projections, right? But never underestimating the usefulness of the qualitative as well. And and we saw this works really well for the final combination. And again, if you work with a consultant or if you do valuation yourself, then obviously there's a trade-off of using more methods, which is you need to spend a lot more time on your valuation, which sometimes you don't have, or money, right? And which definitely why we made Equidam. But the idea still remains that more methods are gonna give you a better idea of the valuation. So let's say you have done all this, you work with us or with somebody else, you got your valuation. How do you talk about it? How do you negotiate it with investors, right? So normally, in terms of how to talk about the report and the valuation, we normally advise to understand just that valuation is uncertain, that even if you've worked with us or even if you've worked with Axelra or everybody, you're still gonna have assumptions in there that are gonna be different from what the other party is gonna believe, right? So then the valuation is the outcome of these assumptions, right? Is the valuation based on these assumptions, and we can reason with investors or with third parties to understand what they believe, what is their feedback on those assumptions, and if something needs to be changed, right? Ideally, if you get to the same belief around risk and return of the venture with a third party, you should also agree on valuation as well, right? So if we both believe that the company has 100% certainty of making, $1 million next year, then we should also agree on the valuation. And then the other question is, when do you talk about these things, right? So again, round planning and stuff is a big topic as well. But when it comes to valuation, everybody has a tendency to leave it for last, right? At the last meeting when you're talking about the term sheet. And we think that's sort of okay if the investor is experienced and trusted, in the sense that they also have an incentive to give fair valuations to startups. Otherwise, they're going to be out of business. Nobody's going to want to work with them afterwards. However, a lot of the times, especially for very early stage rounds, you might be dealing with people that have less experience, or they don't need to be this professional in valuations, and they don't need to be this professional with you. And then in that case, it's a lot better to bring up the valuation earlier, like almost the second meeting or even the first meeting, just as a range to just understand, okay, if we go forward and we talk more, we are talking about the valuation in between this and that. And that kind of allows you to set a bit the expectation. And if it's a no, at least you get the no early, rather than going forward, wasting time, saying no to other investors that might be interested. And then you end up with a big disagreement on valuation, just because sometimes, people have extremely different assumptions and or knowledge or whatever it is. And then the deal doesn't conclude. Yeah.
May I quickly show the beautiful reports we are talking about, because this is really I cannot stress out that more, because it's a really lovely thing, this report. And as Daniel mentioned, it's important to understand how that one works. I mean, first of all, they do have, and you also get that an extensive description of how they rate it and how it works. We also send that over afterwards, and all that methods are going to be explained. But the valuation report itself, it's really powerful. You also get, that one is a sample report where it shows you, okay, look, this is the forecast and this is the round and this is the valuation. Here are the 5 reports. It gives you a low and a high bound. And as Daniel mentioned, it's not about exactly the number, but you have a very good starting point where you do get a lot of information about it and also from other rounds. And it simply does very much help you in the discussions.
Yeah, exactly. So like we designed it, it's about 30 pages these days, and we really designed it to be transparent and easy to understand. So it's not like a book that people are just going to look at a number and then throw away, but it's more like trying to really explain what are these assumptions behind the valuation so that they can be negotiated, they can be discussed, right? With the goal really of trying to get to a deal that is fair to everybody, right? That is fair to founders, whereby they have the right incentives to make the company successful, right? They don't end up with like 5% of the equity and they want to quit next year. But it's also fair to investors, allowing them to make the returns on their capital as well.
Let's speed up a little bit. I will cut your time. I'm very sorry, my friend, but if not, we do have too less time to talk together. we should avoid that. Thank you very much. I just quickly go there. 2 things. We compiled an early stage map. It's axelra.com/funding map, where you see the model, but then you will also see what kind on stage of the organization in that model. You can go either to incubator accelerators, you can go to grants, you can go to syndicates, you can go to VC firms or family office, and what are the categories and the industry they do kind of invest in. And that's a very helpful thing in order to speed up the process. And one thing I'm very happy to show you is you can get that quick venture valuation report from Equidam. Oh, no, wait. Here, wait. Has been started, at what stage you are, and then you get at least a first indication on how it is. And here you see selecting the stage of the company, if you break even, what the revenue you did the last years, what's the revenue projections you're going to have for the next 3 years. Hit your information in, you will get a first indication of let's say what's the min value or the max value and the average. You don't get the full report, of course not, but still it's a good first idea of checking that and seeing. And after we calculated it, it will provide you the result. It takes around 5 seconds or so, but it's a really lovely tool, and we just open it right now for everybody. Link you will find also in the confirmation email. There's a lot of statistics as well about others and so on and so forth. And with that, I would like to go to the interactive Q&A session. Any questions?
Let's see if people write some questions in the chat.
Confirm you're speaking.
While we wait for that, I actually have a question for Daniel. I'm curious to know, since you have such experience about valuations, obviously, are there any common mistakes or anything common that takes founders by surprise when they conduct a valuation? You have your mic off, Daniel.
Yeah, I don't think there are too many, to be honest. Like the ones that we follow, like we have a standard process and it's fairly easy. I think, well, I mean, it's more like about the process, right? So it's really like the planning, the fundraising and making also financial projections that is a bit more difficult. I think a lot of people don't consider that they think it's going to take less time, right? And they work a lot on the plan and on those things, but then the financial projections, because you have these interactions from marketing and sales and product, and everybody needs to chip in, then it takes a bit of time to do. luckily, like the valuation doesn't anymore. If you do it with us, like you can do it in 1 hour. But otherwise, if you are talking with the advisors or so, then it's a surprise that it can take like 2 or 3 weeks. So we work with a lot of founders that really are like, hey, we have a meeting tomorrow. We need to have a valuation today. And I'm thinking like, why didn't you just plan a little bit? I'm not asking for like months, right? So that's the only thing that we see people a bit surprised still, but otherwise, yeah, it's better than it was. Yeah.
There was a question from Raul: how accurate is the pre-revenue evaluations? I mean, that's also actually a question for Daniel, but just one thing. I mean, in the end, and this has not been mentioned before, it's always, if you offer somebody needs to pay, and then you have a deal. If not, it's just fantasy. And the market is pretty bad at the moment for raising funds, and it's also not always the same. So it's always depending on the things. But the valuations Daniel has in his database are pretty good. My let's say perspective on it. Do you want to add something to that?
Yeah, so the way we think about it is that what we try to do is to reflect the story that the company has in numbers, right? And then whether that story is believed or not, that's very, very difficult for us to assess. It's actually up to every individual investor. What we know is that we actually, if you do the valuation with us, after a few months, you're gonna get a survey, and if you fill it in, we send you a T-shirt. So it's a nice one-to-one. And we ask people, how did it go with investors? Was the report useful? Has it improved the conversation and stuff? And we have, I think, 94% positive on that, which, considering how critical the conversation is quite a good number. So yeah. Hi, Raul. Now I recognize you. I didn't know if it was you. Yeah. Nice. Good to see you.
Let's
Anything
see
else?
any more questions.
Here is one more from Manuel. What kind of input are required for calculating valuation? Daniel.
Yeah. So we're going to need financial projections for at least 3 future years. And those are fairly high level. So revenues and costs, basically. And then it's an easy questionnaire with 35 multiple choices questions. And I see, Manuel, you were asking if investors are using it. Yeah, we have about almost 2,000 investors that used our platform. And yeah, that's it.
Mm.
Take this.
Do you want to take the question from Alan?
Yes, let me quickly. Okay, a longer R&D phase, financial plan over 6 years rather than 4 years, which is more common. Yeah. Yes. So predicting the future over 6 years for a startup is quite a heavy task. However, you need to show investors a road to profitability. Maybe if you're R&D heavy, that's only 8 years out, but you need to show how you are going to arrive there, which is pretty important. And as Peach mentioned, it has become even more importanter, if that's a word, over the last 2-3 years. So investors are not just looking for growth, but really profitability. And I think it's really important that you show them a way there. If it's longer, yeah, that's okay. But then the opportunity probably needs to be bigger.
Yeah. Daniel Steven Gerhard has a question for you. He asks, how does the contribution of software IP flow into the valuation? And for example, the person years times salary to build the product.
Yeah. So that's what I was saying before, right? So every asset, whatever time you spent on the product, like maybe you gathered a lot of data, maybe you have a factory. So every asset doesn't contribute to the valuation on its own. It's more like what it allows the company to do, right? So the fact that you have spent that money, that you have that product, allows the company to have a certain story of the future and to have a certain future, to be honest. And that is what contributes to the valuation, right? So let's say I have invested like 10 years ago, well, or 5 years ago in a product, and now that product is generating money. That's gonna contribute to the valuation. So it's whereas if I didn't do it right now, I wouldn't have that revenue and I wouldn't have that growth in the future. So the two valuations of these two companies are gonna be different, and that's the contribution of that asset. Can you single-handedly point it out and say that asset is worth, like, for example, for a brand or something that is really ingrained in the company, that asset contributes like 400K? You cannot really do that most of the time because everything is really interconnected. Yeah.
Thank you very much. I can see that we're hitting a bit over 1 o'clock here. I just wanted to make everyone aware that is here. I saw that there was a question about the funding map, that maybe some people wonder, where can I find the tool, this valuation tool that Pete showed us? And this will all be included in the thank you email that we're sending out tomorrow morning to all the participants in this webinar. So if you wonder where to find things, look in the thank you email. That's where it will be.
Cool.
And then I also recommend to like connect with, you know, Daniel, Pete, and Stefan. If you have any questions, you can always reach out to them via LinkedIn, email, etc. as well.
Yes.
Amazing.
Cool.
And there we are. And I hope everyone has a good afternoon. And I hope to see you maybe at the SSA Summer Nights or in another webinar. And until then, have a good afternoon, everyone. Thank you.
Thank
Have a good one.
you.
Thank you, guys.
Thank you. Thanks, Pete.